Hi dear traders, in the last 10 days the US money market funds have seen the largest inflow in almost 2 months. Last week investors were making decisions relying on strong statistics data. This week most of them are looking forward to the Jackson Hole Symposium. Possible actions by the Federal Reserve are still the main trigger for markets. Last week's data raised the likelihood of another key rate hike this year. Firstly, the Fed published its latest meeting minutes. The protocol showed that the regulator remains stuck to its hawkish stance. Secondly, data on U.S. consumer prices, retail sales, and the labor market turned out to be better than expected. This allowed the Fed to leave the door open for a further rise in the benchmark rate. Concerns about future hikes by the Fed caused a decline in the market last week. Notably, the pressure is likely to remain in force until the end of this week, when the economic symposium in Jackson Hole will start. It is highly likely that Fed Chair Jerome Powell will repeat the necessity of keeping the benchmark rate at a high level for a longer period of time. However, investors may find some hidden sense in the words of the Fed officials and react to them. According to the CME FedWatch Tool, the likelihood of the key rate hike in September is 15.5%, while in November it's more than 43%. As we can see, the difference between doves and hawks is becoming less noticeable. Notably, analysts at Goldman Sachs suppose that interest rates in the United States will stay at the current or a high level for about 10 months, that is until May 2024. Last week, investors started searching for safer assets such as the US dollar and gold against the backdrop of strong US data. Thus, on Wednesday, August 16th, US equity growth funds reported a $4.16 billion outflow. Meanwhile, the S&P lost about 3% in the last 3 sessions. This is the sharpest 3-day drop since the middle of March. On the other hand, U.S. investors remained net sellers in risky equity funds for a third straight week as they pulled out a net $2.77 billion. Thus, the S&P was affected more than others. By Friday, it has slumped to 4,340 points from a peak of 4,500 points. The biggest losses were recorded in healthcare, finance, metallurgy, mining, and utilities. The energy sector is one of 11 sectors that showed a rise amid oil changes. According to the data in the second quarter, the revenue of the companies including in the S&P decreased by 3.6% on a yearly basis. Since the reporting period is almost over, the S&P's income may stay in negative territory. During the last 10 days, traders have been actively monitoring the situation in China. The economy has been slowly recovering after long-lasting isolation. The most alarming situation is seen in the real estate sector. In July, the house price index dropped to minus 0.1% from the zero level. Chinese large developers are in distress, and the second largest development company, Evergrande, announced its bankruptcy on Thursday. Since this sector accounts for about 25% of the Chinese economy, concerns about a possible collapse are rising. China's domestic problems have affected Chinese companies registered in the US. As a result, shares of NIO, an e-vehicle producer, depreciated by more than 4%, whereas shares of Alibaba lost 3.4%. There is no wonder that traders were skeptical about today's revenue report for the search service Baidu. Yesterday, the company's stock declined by 1%. In addition, the United States has limited investments in Chinese tech companies. In this light, the firm's revenue may slide even more. Also, this week on Wednesday, U.S. corporation Nvidia will report its financial results. Yesterday, shares of the US largest producer of chips increased by 5%. Since Monday, August 21st, they have risen to $470. Curiously, since the beginning of the year, the share price has jumped by 200% amid the boom of artificial intelligence development. The company's chips are used in most applications for artificial intelligence, machine learning, and data centers. The fuss about new technologies that we've seen this year may favor Nvidia more than other companies. Meanwhile, changes in the share price have reflected great opportunities for the company amid the artificial intelligence introduction. The market was really surprised by the rosy future of the chip giant. All 33 Wall Street analysts who are monitoring shares of Nvidia have upwardly revised their forecast. Adjusted earnings per share now total $2.09. Nvidia's shares are trading on the NASDAQ exchange. Optimism about the corporation's large revenue supported the technology sector of the market. Notably, last week, from Tuesday to Thursday, the NASDAQ suffered the sharpest drop in the last 6 months. As a result, the index lost 3.4%. As investors are considering the scenario of a higher interest rate for a longer period, risk sentiment has dropped, thus affecting stock indices. The most significant decline was recorded in the NASDAQ, which includes such giants as Apple, Microsoft, Meta, and Tesla. As we have already mentioned, the index slumped by 3.4%. Nevertheless, companies somehow connected with artificial intelligence remain the key drivers of the sector. That's why, after a tumble to 13,180 from 13,720 points, the NASDAQ launched a new upward correction. The index opened this week with a confident rise. Today, it has reached the level of 13,498 points. Meanwhile, the situation with Dow Jones did not change early this week. From August 15th to August 18th, the index showed the deepest drop since the beginning of March. As a result, it lost 2.5% and nosedived to 34,280 points from 35,154 points. Although yesterday, at the end of the day, it started gaining in value, it was still hovering in the red. The Dow Jones Industrial Average differs from its counterparts, namely S&P and NASDAQ, by having lower resilience. It measures the performance of 30 large and popular companies, the so-called blue chip stocks, and reacts to all news with delay. It's highly possible that today's reversal in the Dow could be explained by the expectations of the quarterly report of US retailer Walmart. Today, shares of the company increased to $160. What's more, Walmart has lifted its forecast for the whole year. On Thursday, investors expect another positive quarterly report. It seems that the company is benefiting from inflationary pressure. Sales in the US stores on the same name jumped by 25%. In the second quarter of 2023, the firm's revenue soared by 53% compared to the previous year. In addition, sales at Walmart's US stores open for at least a year rose by 6.4%. This is all for today. Do not hesitate to comment on the video and ask questions. The InstaForex TV team is working for you. We wish you a profitable trading day. See you next time.